You know, it's so good to see you, my people. Welcome back. If you've enjoyed the research insights that I've shared so far on my channel, well, you're in for a special treat. You're really going to like this one. Today, we're going to dive into the hotly demanded topic that you, my friends on YouTube, have been asking for: short selling in the stock market. I'll be walking you through some insights that are a bit more advanced too. So get your notes out, as there will be some juicy details. These insights are not found on other videos on short selling commonly found on YouTube, and they're definitely a bit more advanced, so get ready. Now, this topic is a must-watch, given that I've said on my channel that we are approaching very seriously peak valuations. And if you've been following me for a while now, you would know that I've been bullish on markets, and hopefully together with me, you've been benefiting from this incredible run. But at some point or another, it would be reckless to think that stocks, crypto, or housing go in one direction only. And I want to equip you with the ultimate form of self-defense: short selling. This approach is certainly not for everyone, but for those of you who are serious about finding ways to be on the right side of the trade in 2022 and beyond, this is a must watch. Now, I expect a lot of returning friends in today's video, but if you're new, I want to let you know that I got in touch with my inner Shiba Inu, and the god of the dog coin says you must subscribe to Larry's channel to spread the insights that are just so profound. Turning on that bell is also a must. Now, jokes aside, whether you're a beginner or seasoned investor, my promise is always this: you'll learn something new and be able to apply it right away. So let's get into it. I'm going to be walking you through the fundamentals and basics of short selling. Now, if this is already known to you, then watch this portion of the video in 1.5 or 2 times speed to get a refresher. There should be a marker in this video that shows when the basics are finished. Now, I'll also walk through what are the more technical things to know behind short selling that isn't commonly talked about. I'll also talk about the more advanced perspective relating to short selling with institutional investing approaches. I'll talk about what I personally look for before starting a short position and how I'm going to go about short selling if necessary. So here is the foundational information that you need to know when it comes to short selling. Most investors buy stocks for the long term. They purchase stocks at a valuation and at a price they like, and in the future, as that company grows its revenues and its profits, the stock price eventually follows that same trajectory. This is the timeless investment strategy known as fundamental analysis. This is also the strategy that most of you and I follow when it comes to investing. At some point in the future, these same investors who bought previously at the right time will be sitting on a lot of paper profits. And they will have the option to keep holding if their outlook on these companies continue to be positive, or they can choose to sell if they believe this company's growth has run its course. This is called taking the long side of the trade. You buy stocks when the price is low, and you sell when the price is higher. Short selling is essentially the exact opposite of this traditional investment strategy. You want the stock price to go lower if you're short selling, and you are essentially betting on the decline of a company. Now, people who sell short companies are speculating on the fact that a company's business has not only peaked in the market, but also may be facing imminent declines in its prospects. You borrow shares with a margin account, and to close out your position, you buy the shares back at the market price. So from a fundamental perspective, short sellers believe that certain things are likely to happen, that revenue growth slows down, or even decelerates, or even goes negative. Cost structure of the company goes up unexpectedly and in an unhealthy way, or increasing competition takes over market share of this company and decimates its gross profits, gross margins, and its net income. These are typically the reasons a speculator would want to take a short position on a company. So in the market, there are 2 sides to the trade: People who believe the company's prospects will improve and therefore long the stock, and people who believe a company's prospects are deteriorating faster than expected and take a view by shorting the stock. Now, I want to take a moment to describe some more technical things that you might want to learn about. And this involves knowing things like the additional cost of short selling, the fact that there are something known as easy to borrow shares and hard to borrow shares. I'll also talk about locate fees and what float and small cap stocks and institutional ownership have to do with it. And finally, I'll talk about the importance of margin maintenance. Now, short selling can be profitable, but it is a lot more difficult to pull off because it's simply more expensive than buying a company and being in a long position. When we short sell stocks, we are essentially doing the inverse of a long trade. So while long holders receive dividends, if the company provides it, short sellers actually need to pay those dividends out to the long holders. Also, some brokers have what are called locate fees. So make sure to confirm with your broker's website that there aren't these fees. I personally use several brokers, but TD Ameritrade is my main one. For a deeper list of what brokers I use, check out my description below. Now, TD does not have locate fees for short sales, but that's TD Ameritrade and not necessarily representative of other brokers. Certain brokers also have a list of stocks that are easy to borrow and a list of stocks that are hard to borrow. Stocks that are hard to borrow will have higher fees and potentially have a higher margin maintenance, which is what I'll describe next. Now, margin maintenance is a very important concept. Different brokers sometimes have different margin maintenance levels, but I'm going to use TD Ameritrade as an example. I'm going to explain. First thing that you want to write down is this. If you use margin, you have a couple things to look at. How much you took out as a loan and how much money you put in. We call that equity. The loan is margin. You add that up and that's your total value. So three terms: equity, the margin loan, and the total value. So if you put in $40,000 of your own money, that's your equity, and then you use a margin loan of $10,000, then the value is $50,000. In other words, 80% of your position is your equity and 20% is your margin loan. So far, so good? Now you want to write down that you never want to have the equity of your position be less than 30% of the total value. Never, ever. Here's why. 30%. At your brokerage, typically the standard margin maintenance on a long or short position is 30% of the value of a position. And I'm going to walk you through the math of what margin maintenance means through a traditional long position and then walk you through an example with a short position. Now, in plain English, that means your ownership of the position needs to be at least 30% of the position value to keep using margin. Fall below 30% and you're going to get a margin call. Let's look at this table. We'll use the same example with similar numbers. Let's assume that someone purchased stock ABCD at $50. Let's say you bought $40,000 of that stock with your own money and you used a margin loan of $10,000. So the total value of your position is $50,000. Here you own 80% of the position and 20% of the position is a loan. If the stock falls to $15, then you now only own 33% of the position and the loan becomes 66%. As you can see, the equity is dangerously close to 30%. And once the equity value falls below the maintenance requirement, you'll be issued a margin call. Generally speaking, as a result, it's almost never a good idea to let your equity percentage drop below 50% unless you're a professional. Because if you're a professional, look, you can do whatever you want. Now, for me personally, I almost always ensure that my equity percentage doesn't fall below 70%. If it does, I'd rather take a loss on my own positions and lower the use of margin in my account. Now, on the short side, and this is important, the math is much more sinister. Yes, we logically know that if the position you're betting on rises in value, your equity percentage falls, you're taking a loss, and you are moving closer to margin deficiency. However, look at this chart that I created for you. Your equity value shrinks a lot faster if the stock moves higher if you're short compared to when you're long. Now, here are some conclusions that nobody really tells you, but I've analyzed for you. Based on a broker like TD Ameritrade, assuming that the maintenance requirement is 30%, on the long side, the stock would have to fall 66% before you get a margin call. On the short side, though, if the stock goes up approximately 50%, you get a margin call. So you can see here that the margin of error on the short side is a lot lower than the margin of error on the long side. Now, based on what I understand from my comment section in my YouTube videos, I'd say that using margin and short selling is something that only my more advanced friends should use. Now, friends, this is where the basics end. And what I've said so far is pretty much representative of what a lot of YouTube videos talk about on short selling. Now, I had to go through the basics because I don't want to assume that you know everything already. After all, as my YouTube friend, I only get to know a couple things about you. That you're most likely 25 to 55, that you watch Meet Kevin, and that you guys really like my stuff. Now make sure you also become my Instagram friend by following me at larry.g.chung. Now, from my comment section, I know that a number of you guys are a bit more on the advanced side, and if that's you, get ready. The next part is where I talk about the stuff that very few people talk about. The first advanced perspective I want to share with you is this. According to the IRS, whether you hold a short position for less than a year or more than a year, you'll have to pay short-term capital gains on any winnings from your short position. Now, this fact, along with the data that I've showed earlier, should make you recognize the challenging aspect of walking away with substantial net gains from short selling. I know a lot of my YouTube friends are also international, but just to show you a quick table of the US tax rates, you can see that you could be easily paying 1/3 or more of your short profits if you make over a certain threshold. Now, if that doesn't deter you from learning about short selling, then you're ready to go. The next advanced insight I want to share with you is that short selling is very difficult under the following circumstances, which I'm about to lay out. Keep in mind, this is where we venture into the world of my opinion, so be sure to understand that these are my personal views only. Now, here's when I think short selling is a very challenging endeavor, and I'm going to go out and list these criteria. When the Fed funds rates are near zero, because that indicates strong liquidity in the marketplace. When the 10-year yield is low, because that makes bonds an unattractive place to park capital, and bonds are one of the biggest competitors to equities. When credit spreads are low, indicating that the chances of default of companies is low. When earnings growth and profit margins continue to be very strong, which keeps valuations high. When companies continue doing share buybacks, because that increases the quality of EPS to shareholders. When market breadth is broad and not narrow, because that means the entire market is participating in the rally, and when companies are hiking dividends, because that makes shorting more expensive, since shorts have to pay out dividends to the long holders. Now, as of today, many of these criteria still check off, and that makes the bull market still quite strong. As a result, effectively short selling today requires active stock picking as to what companies are overvalued and which companies you are very sure that other people will discover to be overvalued and then sell later. That's a very difficult spot to be in. And we'll use Citron Research as a case study as to what happens when you attempt to short high growth companies in a bull market. Now, before we discredit the use of short selling, though, in a bull market, we're going to see that short selling requires a level of research conducted that long holders typically don't do. Now, I know academic papers aren't always a source that we can fully rely upon when it comes to dynamic financial markets, but we have to trust that academic research does play a powerful role in investing as it sets frameworks. Now, from an academic paper on short selling, it is proven that short sellers typically have an informational advantage compared to long holders. In order to have their short bets be profitable, they simply need to be more informed about the company. As a result, empirically speaking, when a company is heavily shorted or has significant short interest, these companies typically have weaker subsequent returns. This makes sense because short sellers have typically done a heavier round of due diligence. Now, we can take a look at Citron Research as an example. Andrew Left is a very powerful person in finance. And after reading some of his research, I can see why he has gained such incredible recognition. Back in December 2019, Citron issued a short report on Peloton, saying that the company was excessively overvalued and put a price target of $5. Now, while this call hasn't been correct, in investments, I urge my friends and my viewers to not always judge the end result of a call, but rather the process. Now, I know that money can be an emotional subject, but sometimes professionals will be wrong in their calls. I've been wrong too in my career, plenty of times, in fact, and it's okay. Remember, if you trust my wisdom, it's to take away that the only thing that matters in investments is how much did you win if you were right, and how much did you lose if you were wrong. You can be wrong and still make a comeback if you didn't dig yourself into too deep of a hole. And remember that if the process and research are solid, it's only a matter of time until the analyst or strategist is rewarded. So in this case, Citron was incorrect in terms of their call. But they looked at Peloton in a way that the sell-side Wall Street equity analysts didn't look at. If the market had taken the following narrative seriously, then Peloton could be indeed trading at a very different price. They looked at a metric, a very creative one, known as enterprise value per subscriber, short for EV divided by subscriber. And they compared those metrics with other subscription-based companies in a peer category. In my mind, this was a very creative way to understand its business relative to other subscription businesses. Now, even though their Peloton call never came to fruition, this type of analysis can actually open our eyes into whether the peer companies were overvalued or undervalued as well. An example is Spotify, a company that I personally like on the long side. This Peloton report was written in December 2019. Now, at the time, we can see that Spotify's EV over subscriber metric was quite low compared to its peers. Now, this implies that if Spotify diversifies their business model, it's possible that that metric is too low. Now, even though most companies did see a dramatic bump from the pandemic lows, if we study Spotify, it seems that their drawdown was much less severe compared to their tech peers, and they experienced more upside during a recovery. Now, I actually used a similar analysis on Spotify earlier this year, and that caused me to go long on Spotify at very favorable prices that you'll see in this image here. Now, Spotify is one of my best performing positions in relation to the time frame that I've held this stock. Now, as you can see, studying companies from the short side can also give us an indirect advantage on the long side too. Next, I want to talk about commonly used ratios in understanding stocks that we're thinking about shorting. And these metrics are numbers that we typically see on general investing websites, such as the short interest ratio, the short percentage of float, short percentage of shares outstanding, shares short from prior month, and the days to cover. Now, all these metrics can be very valuable when a community such as Reddit orchestrates a massive short squeeze on AMC and GME at the time when their market caps were much lower. But for blue chip companies like Peloton or large caps that don't have a large float being shorted, these metrics are a little bit less helpful. So here's my takeaway from the Citron case study. I would almost never recommend that any of my friends on YouTube to short single name companies. I've had very little success shorting individual companies. The level of research that you need to do is very deep, and even then, you might mistime the trade. And on top of that, you're responsible for short-term capital gains, short selling fees. But just because I don't think that you should short single name companies doesn't mean that you can't profit from short selling. You have to use it the right way, with the right vehicle, and at a time when the macro picture makes sense for this strategy to work. So here's what I'm planning to do. Listen carefully. We're in a seasonally strong period of the year where we will most likely see a combination of low volatility and an upward trending broader market. That said, these rallies are happening in the face of continued hot inflation in the background. And bondholders aren't stupid. They're going to dump their bonds, which will push up their yields, because right now those bonds are yielding less than 0% after inflation is adjusted. This will naturally start putting more gravity on the stock market once yields are higher. Rising yields and cutting QE has the combined effect of a milder rate hike. And in addition, the Fed knows this. While the investor class has been able to benefit from inflation through the stock market for now, the rest of America is left behind because many families do not own stocks and assets. Eventually, the Fed will realize that CPI is hurting the purchasing power of 90% of Americans, and they will have to serve their mandate of keeping inflation back to their target 2%. And once the Fed starts to tighten, here are my thoughts. Technology companies that have large expected cash flows in the future will see their valuation shrink dramatically. And by my estimates, approximately 30% of the S&P 500 is characterized by these kinds of companies, making the index quite vulnerable. Companies that are also in the high yield space, like energy, will start to see strain on their balance sheet. Financing will become more expensive, and any companies with variable debt will see a significant drag on their free cash flow. Sectors like energy and industrials could see their latest run-up get derailed by higher interest rates because they typically have higher leveraged balance sheets. So how do we take advantage of a falling market? After a lot of consideration, I think the best way to profit from market declines is not to short high beta tech names. If you mistime that, let's just say that that could ruin your alpha. And I wouldn't want that for you, okay? The best way to take advantage of a falling market and making it out much better than your next door neighbor is through the following scenario analysis based on your risk tolerance. You have several scenarios to analyze here. Take a look. Reducing long positions so that you can build up a cash position to buy dips. Reducing long positions and then starting short positions as a hedge. Going net short by having your short positions be heavier than your long positions or be fully short. Now, I think it's reckless to stand still in a bear market and let your portfolio get run over by a train. But I also think it's reckless to think that you could use the train wreck fully to your advantage by being completely short. So I think the best way to take advantage of a falling market is significantly hedging your positions or being slightly net short by shorting the broader indexes via a short position. I do not recommend using inverse ETFs because if you're using margin, taking a long inverse ETF actually adds to your long margin position and that adds to your margin interest. Whereas if you short the index against your longs, you are synthetically reducing long exposure and the balance on which you are charged margin interest also does not go up when you short against your long positions. Now, although you are free to do what you want, my approach will help you to not be exposed to a short squeeze of an individual company, but at the same time protect your portfolio against a macro decline. Now, what about put options, you might say? Well, options is another animal of its own, and I'll cover that at some point in the future. I'm convinced that my research leads me to believe that the party can't last forever. Right now, everything is good, but for how much longer, we shall see. Now, I had a friend on YouTube ask me this question, asking how he can support me because he really enjoys my work. And these comments are incredible, and I just want to say thank you. And as for the comment on Patreon, I am working on a research platform that I will announce in the future for anyone who wants to work with me on a deeper level. Now, I also had this question here. And this question was, Larry, what do you think about the shorting entry, the shorting exit, and what percentage to take for a gain? And that's a good question. But here's how I'm going to answer this one. Bulls make money. Bears make money. Pigs get slaughtered. Don't be too greedy. And when you feel like you've made enough from your short position, walk away. Bear markets don't happen too often, so when they do, the first thing is to be grateful that you're on the right side of the trade and don't overstay your welcome. Just had to drop that wisdom there. Now, if you need a refresher on inflation and the emerging risks, here's that video. And if you want to understand how stagflation could paralyze the market, make sure to watch this video here. With that said, you know that I'm on your side. Share my videos with friends and family. We're approaching the holiday season. I want you to know that I'm very thankful for you, and I hope the feeling is mutual. See you next time. Stay tuned for more insights later.